Deep into day one of that Fed meeting, our next guest says no news from the Fed is good news. Diane Swonk, chief economist at Mesirow Financial, follows the Fed. She joins me now from Chicago. Diane, good to see you again. And as Kathleen Hayes just mentioned, the conventional wisdom, at least from across the spectrum, is that as far as the Fed's concerned, no intention to withdraw liquidity, no intention to raise interest rates. Is that your take as well?
Absolutely. I mean, at this stage of the game, the more the Fed says, the more damage they could cause. I think staying on message is important for the Fed today. The fact that they're not going to raise rates anytime soon, I think this was sort of the markets were premature in trying to price in Fed increases, some before the end of the year. I don't think the Fed has any interest in raising interest rates before it deals with its balance sheet, and I think it expects to continue to expand its balance sheet, especially in the longer-term areas. At the end of the month, we'll have those first commercial mortgage-backed securities that it purchases out there, which will be one of the biggest challenges for the Fed to date.
How long can the Fed keep its commitment to keep rates in the zero area?
Well, you know, part of the reason it went to that commitment was because that's where rates were by default. They couldn't keep rates up. They were automatically going down. They couldn't defend their Fed target. So I think they can keep it for a fairly long time. I think well into 2010, even to the end of 2010, I don't think inflation is a major risk at this stage of the game.
Well, are their hands tied by the jobless number?
Their hands are tied by the jobless number, but of course the jobless number is part of the reason inflation isn't much of a problem. And in fact, the minute that energy prices popped in recent weeks, we saw a demand reaction, weaker retail sales, weaker spending out there. So that kind of tells you that the Fed really doesn't have to even worry much about commodity price inflation because it will take it out of other consumers' other pockets, which makes them worry more about growth than inflation.
And they won't have any comment on the Treasury market, will they?
No, I don't think they'll have any comment on the Treasury market. I think that would be it would be foolish to comment much on it. What the Fed really has to sort of underscore at this stage of the game is they've committed $3 trillion. They've got $2.2 trillion out there on their balance sheet, and they can go up to that $3 trillion limit or not as conditions sort of evolve. They could also extend it. So they just need to leave themselves completely flexible at this stage of the game.
Well, is the commercial mortgage-backed security program, is that going to change the landscape?
You know, this is one of the real questions out there. The next biggest headwind we face is commercial real estate. We've already seen declines in commercial real estate construction, but a lot of what's out there needs to be refinanced in the next year to 2 years. And as it's starting to roll over, we need to see the commercial mortgage market come back a bit. It is dead right now. It's been dead since August 2007. And in fact, the Fed requires 2 AAA ratings on any debt that it does purchase that's commercial mortgage-backed securities up to 5 years. That's hard to get in this economy today.
And again, if I could go back to that jobless number, when that jobless number at least gets away from the double digits, is that when we're going to see the commercial real estate market start to rebound?
You know, ironically, because we're not investing heavily in commercial real estate today, and we didn't overinvest as much as we did in previous cycles, 2 to 3 years down the road, we likely will see very tight commercial real estate markets, and that'll be a real opportunity. The problem is you got to live between now and then to make it there.
Well, how do the banks look so far? Are they starting to come out of this slump?
You know, the banks are actually looking pretty good. This is a great environment for banks. Their spreads are great, and the stress tests really were very stressful. They even stressed out to 2011 on some shadow stress tests for the commercial real estate market. So I think the banks are going to be in okay shape. You know, we've really seen very few failures because most of them have been merged into other banks. The real challenge, the next challenge down the road will be how do we get rid of the too big to fail problem, because now we've got two too big to fail banks.
Diane, in our last minute, Kathleen Hayes brought up an interesting point during the press conference today. President Obama was asked about Treasury Secretary Bernanke. I'm sorry, Fed Chairman Bernanke, excuse me. I don't know if you would call it qualified support, but he didn't really want to get into it. In that instance, was less more from what the president had to say?
You know, I think what we're seeing is, you know, the posturing that's going on. I would like to see by Labor Day the decision with regard to Chairman Bernanke made or not. I certainly think Chairman Bernanke continuity at this stage of the game, we're still in a financial crisis, is probably the right way to go. Larry Summers is very talented as well, but right now continuity may trump that. And, you know, Bernanke has done a lot of out-of-the-box thinking in dealing with this crisis, and he does get a lot of credit for that. Right. I just think it might be too much for financial markets to have that incontinuity rather than continuity.
Diane Swonk of Mesirow Financial joining us from Chicago. Thanks.